Morning, folks. I hope you can hear me clearly. Please comment where you are joining from. Good morning. Good morning, Sarat. Good morning, Ayush. Good morning, Gangnam Style. Good morning, Ambikapur, Chhattisgarh. Nice. Hyderabad, Sarat. Very nice. Pune. Hello, Yashwardhan. Hello, Abhishek. Good morning, SNP. Good morning, Sharad. Hello, Dr. Ayan from Kolkata. Bharadwaj from Bengaluru. Good morning. Tirupur. Good morning. Karikalan. Ramaswamy from Chennai. We have a very nice distribution all over the country, sometimes from overseas as well. Good morning, Mr. Mehta from Mumbai. Ramesh Desai from Gujarat. This is going to be 1 hour long. We will have a 15 minute market discussion, and then we will have Q&A. And we will start in about 2 or 3 minutes. We'll give more time for people to join. Good morning, Sashi. Good morning, Rakesh. Thank you, Somesh. We try our best to share whatever we learn. Abhinav, all our performance details are on the small case website or on the weekend investing website. You can please go check there. We can't talk about it on public forums as per the regulations. Specific stocks we will not be discussing. So please don't send questions on that. And questions you can send me later. Right now, we're just going to start in 1 or 2 minutes uh, for a market discussion. Okay, I think just 60 more seconds and we'll start. Yes, Abhishek, we are working on more US based strategies. Hopefully, we will be able to offer some US products in this current year, before the end of the current year. Good morning, Garv. He says you are no bullshit influencer on YouTube. I don't know about that, but there are many, I think, people on YouTube and Twitter who are doing a good job, but of course, uh, there are others as well. Impact of war currency on stock market. Okay, we'll discuss everything. Let's get started. I think we have a good quorum now. Thank you so much again for joining this morning. Let me just present my screen. We'll just go through some charts. Nothing prepared for any specific. So just let's go to. So this is uh, the heat map of last 1 month. So we can see that in the last 1 month, month of April, if we go back to month of March, right here, you can see that at the end of March, the entire month of February was down, March was up. At the end of March, somewhere here, we were in a potential position to go up, but then in the first couple of days of April, we had the tariff shock, which took our markets from near 23,400 down to 21,800. And from there, we have recovered back and crossed March high also, and have closed here at 24,300. So if I were to sort of go to a monthly chart, uh, this is where the monthly chart is right now. And if you see, we've had a nice run, a good correction of 5 months, and the market is now poised upwards. So, from all perspectives, this does not look like, any sign of weakness to, maybe visit these areas right now. So this entire, channel that we've had from, can you see how nicely, it has taken a support on this channel? Of course, if we were to draw the channel from here, even there you can see it has broken down but has come back up. So from all perspectives, it does not look weak at all. Whether global situation going forward will change this, perhaps, maybe yes, but every time you will see monthlies on long candles like this, long wick candles like this, like we had this last time in June, if you remember the election day. uh, Very very sharp recoveries from bottoms and closing higher from where we started the month are always good signs. I mean, if you go back and see, you will hardly find any month where a very sharp recovery like this. These was some of the sharp recoveries from bottoms, and I mean, right now there is no undue need for any worry as such. I think this has been consumed well, and market is poised for higher ground. If we see Bank Nifty has in fact just done a very natural correction in its trend and has gone up. So some disruptions were there, but the trend has again been taken on, and in fact, Bank Nifty has taken a new high also. In Nifty small cap index, there is more pain, no doubt about it, but that too has recovered very sharply from the bottom. Last 2 months, we have not closed below the open of that month, which is again a good sign. We have not yet closed above previous 2 months high, which I think is a good thing to have. So there is some iffiness in small caps and similarly in mid caps also. But it's a good recovery from where we had reached. And if you see the context, we are still much higher than where we were just 2 years back. Uh, so if mid caps were 11,000 then and 19,800 now, we are up 70-80% over 2 years. Small caps, we were at 9,000, 8,800 actually 2 years back. We are at 15,000 plus. So again, 80-90% up. So from the contextual point of view, market is still doing quite all right. I would think in terms of where we stand today. So coming back to the heat map that we are looking, so this is where the monthly performance of stocks has been. We have seen a very nice comeback in private banks. You can see HDFC, ICICI, Kotak, Axis all have done reasonably well this month. PSU banks have been slow but still positive. Uh, IT has been majorly the component that got hit this month. Reliance has been very supportive. FMCG has done well, 6% Nestle, 4% Lever. Although on a bigger, longer term basis, they are still down from the top quite a bit. Infrastructure, L&T, etc. Steel has taken a beating, and pharma has done all right. If we also see the Nifty Next 50 space, here again. all these real estate folks, interest rate sensitive folks have taken a beating. Defense stocks, oil stocks, pharma stocks, they've done well. And again, cement, steel commodities have taken a beating in this last month or so. So that's the situation on the Nifty. Now let's look at some charts of other global spaces. So this is another, very perplexing sign, and you can see here the S&P 500 has almost exactly, taken support at the previous top. I mean, this is such a beautiful chart from the perspective of charting, that a market which fell from 6,000 to nearly 4850 took exact support at its Jan 22 high and retraced back almost entirely what it lost in the month. And this is when, the GDP is contracting. Even last session, if we just go back to yesterday the market opened extremely in stress, but has fully recovered by the end of it. It is telling you that these markets are not going as per the narrative. The narrative is that US is in already in recession. GDP is contracting, market is going up. So very, very difficult to play these markets based on narrative. So you have to follow, some trends, and basis that entry and exits need to be done. If you see, for instance, 10-year yield, 30-year yield, for instance, that also has not really dropped off. It has dropped off from 5% to 4.7. This is something that really needs to come down for US to be successful in what they're trying to do. So neither US 30-year yield is coming down. Dollar index also is a bit down from where we were, but in the last 1 month, yeah, we are down about from 104 to about 100 now. And but it is looking like it is starting to go up. US dollar, INR uh, is strengthening very, very hard. I think I have the chart somewhere. Let me just plot that. So this is very positive for, yeah, just look at the fall here. I mean, month of April we started. Yeah, we were somewhere near 85.60. We went to 86.60, and we're now down to 84.60. So that's quite a remarkable gain on the rupee, and that's going to help us in our import bill. And I think RBI again will intervene now, because they can't let the rupee get too strong also, or our exports gets crushed. So very tricky situation for the regulator as well, where to regulate this. The US, of course, is trying to make sure that the dollar gets devalued as much as possible versus other currencies. But then, you can't have the cake and eat it too. I mean, you can't devalue your own currency and expect that other central governments will do nothing about it. Gold also is coming off now. Let me just plot gold. Say USD. Yeah. So we started April here at 31,200. It went to 3,500 and is now down to 32.29. So gold is coming off. But contextually, again, you can see in just this year, we've gone from 2,600 to 3,200. I mean, that's almost like crazy kind of a move already, despite this correction. I mean, I would expect maybe 3,100 to come at some point of time. And always look at the longer term picture. There will always be, spurts in every market, but the long term picture cannot be forgotten. I mean, if you see the trend of gold, this was an exponential rise. It will mend itself and then do whatever it needs to do uh, going forward. So Each asset class has a different cycle. So stocks, Indian stocks perhaps are moving in a 5 to 8 year cycle. Gold is moving in possibly a decade or more cycle. Real estate probably takes a decade to 2 decades actually for a full cycle. So different asset classes will move in different cycles. So they need to be measured according to that particular cycle. Um, Let me also see. Bitcoin has been doing well. So this head and shoulders, or this breakdown that happened, that got completed, and Bitcoin is back to 95,000. Although I haven't bought any, neither am I recommending it. But from a chart perspective, it took a very nice support at its previous high and is looking good actually on the charts. So that's where this stands. Overall, I think if I were to sort of view the uh, situation as it exists in the world today, and I only take 2 3 more minutes. uh, US is in a recessionary situation. Yields are not coming off. Tariff has virtually brought business to standstill for a lot of export orientation. All this is going to cause a lot of stress in the coming couple of quarters, is my guess. And it will require stimulus from the governments to kickstart this market again. So I would expect that there will be a flood of money again, whether they'll call it QE or whatever name that they may give to the amount of money in the system is going to increase. And whenever that happens, all asset classes, real assets, stocks, they tend to go up. And I think that is what is being seen in the US market also, that it is discounting that you can't get out of this situation without printing a lot of more money. And that I think is the situation where this absolute valuation of things that we have always been uh, accustomed to, price earnings of this, or this real estate should be valued this much, is not relevant right now. What is relevant is how much money is there in the world and how it is going to get allocated. If that sum of money, pool of money keeps increasing, then all these asset classes will continue to go up as and where these allocation of money will continue to happen without reference to what is the absolute value. So relative valuation becomes important in my view. Absolute value has no meaning left. Just like we see, for instance, FMCG stocks, they are always above a valuation of 50, 60, 70 times earnings, which if you tell any overseas investor that we are investing in a company that has 10% margin, growing at 7 8%, but we are giving it 60 times earnings, they will laugh at you. But that's the norm of India. We continue to have, because instead of next year discounting, people are doing 5 year discounting, 10 year discounting. So it is all a relative valuation game in my view. Um, the the fact is that real estate remains the mainstay of a lot of investors in India, and that going up, and gold going up. Gold, actually, the calculation that I think mentioned a few days ago on a tweet, assuming 25,000 tons is sitting with Indian household, in just the last year and a half, Indians have made $1 trillion in gold itself. Now, some will book profit, some will channelize it into real estate, some will channelize it into SIPs, whatever. I mean, that wealth effect is there, and that is going to go into consumption. So I think India is very nicely placed, and that is what the charts are also telling us, that despite all this hoo-ha of tariffs and this and that and recession, Indian market is barely 10% from its top. Yes, small caps have been hit from the top, but contextually they are still up 70-80% in the last 2 years. So overall, I don't see any situation of any major stress or anything to really not feel good about. Yes, we have lost from the top, but we gained tremendously from the bottom also. That context cannot be forgotten. So with those words, it's 10:50. We have another 40 minutes ahead of us. I'll try to take as many questions as possible. Please avoid stock advisory questions. I will not be able to take those. uh, we will stop at 11:30. If I'm not able to answer any question that you have, please send us a mail, and we will try to answer them there, or we'll take it up the next time. Ayush has the first question. Uh, 2:1 ratio to reward or riding your winners. What works better? Ayush, I don't think I can answer that to the extent that this is a very trading oriented query. So a person who's into that kind of a uh, format of investing or trading will be able to answer. But in my view, uh, riding the winners is a easier setup. 2:1 reward ratio is very discretionary in nature. So which stocks will you pick? Uh, that discretion already could could have a great influence on your outcome and your strategy, in the sense that you have 10 stocks, each could be opportunity for you to do this 2:1 risk reward. We can't put all our eggs in one basket. So how do you pick between those two also? And riding winners, I think, is a much easier strategy. I mean, stock starts to go towards your direction, and you continue to follow that with a potential exit plan. It's a much easier strategy to execute, I think. And many times, when you do a risk based strategy, that you, let's say you're investing in 5 stocks, 1% risk each, a lot of times it becomes very concentrated. But and if you do it over a larger number of stocks, it becomes very difficult to handle and to track them on a very close basis. So usually that 2:1 kind of a thing will work on high discretion day to day trading basis. For a longer term, slower mechanism of investing, I think riding winners perhaps may help. But again, test out your strategies and see where you land. Uh, Dipesh Singh says, "Am I all cap 3-year CAGR is 11% after such a bull run? I know you do not compare it with any other small case, but how long this underperformance can continue? Which strategies alternate to this?" So Dipesh, again, I would say it is matter of timing. You may say in 3 years CAGR is so much. I may say in 5 years CAGR is 30% or 25%, whatever it may be. So it will take its time to do its thing. Right now, it is sitting in high cash, uh, and it needs to get deployed. As and when market momentum is there, it will get deployed. We really cannot uh, justify any particular year. Some strategies may underperform for some time, some strategies may outperform for some time. We have no justification for that. We are following the prescription to the T, and we are reasonably confident that over a 5-year period these strategies will deliver returns. Alternate strategy to all cap, there is no direct alternate, but I mean, you can mix and match. You can do a MI20, which is mid and small cap, and a NNF10, perhaps, which is large cap. So those are rotational strategies. MI all cap is a strategically going to cash absolute kind of a strategy, and that's where we are in this. Harshad Fadke says Paytm, Ticker Tape are selling digital gold. Is that backed by real gold? How much counterparty risk is there? You had mentioned that Nippon Gold Base is backed by real gold. I would assume that Paytm and Ticker Tape also have backing of real gold. It is a matter of confidence. Uh, the only thing is that the ETFs like Gold Bees or other ETFs are regulated by the uh, regulator, SEBI. Digital gold, in my opinion, is very poorly regulated, if at all. Although I think RBI is giving those licenses, but SEBI regulation and SEBI, I think reporting is more tighter from that point of view. So, without trying to say that those are not good, they may be. My confidence lies more with ETFs versus digital gold. And counterparty risk is there in both of them. So, if you don't want counterparty risk, then you have to hold physical gold. Because anytime you are allowing anybody else to hold your gold, there is counterparty risk. Paras Chaudhary says, have you booked any profits in gold? No, I have not booked any profits in gold. I look at gold as an allocation and not as a trade. So, whenever I will find that my allocation to gold at the end of any quarter is, and the end of any quarter or end of any year has gone way beyond where I wanted it to be, I will take that chunk off, regardless of price. So that's how I operate, but that's just my way of doing that. Beauty Singh says you talk about gold and real estate, but if somebody has 10, 15 lakhs only to invest and is looking for long term wealth, does the diversification still make any sense? So, again, I would say depending upon your stage of your investment life cycle, you can choose the vehicle. At earlier stages of growth, you can choose perhaps only equity. As you more get more mature, as you get into perhaps family responsibilities and all those things, you can perhaps add real estate to your mix. And perhaps once you have more excess of surpluses, you can keep adding some gold to it. But yes, I mean, you're right. If you are starting out and have lesser amount to invest, you can certainly not do real estate at that time, because that becomes very, very difficult in that price bracket. Shri Praveen says, can you explain impact of war on currency and stock market? So let's go and see what happened to US markets, let's say in 1970s, where they were they were not really at war in their own territory, but they were staging a war with Vietnam. And what was happening at that point was that uh, all their resources. So this is the 70s where they were staging a war against Vietnam. You can see that the US market didn't go anywhere because all kinds of resources were being directed towards the war. The whole economy was going into deficit. And this is exactly where they had to uh, depeg the dollar from the gold backing. So that's the situation where uh, where you spend a lot of. And let's also look at the dollar index in that period. So the dollar was also coming off in that period. So war usually is going to halt a lot of things. Certainly, it will halt uh, new money going into, let's say, capacity generation. Any entrepreneur who is looking at, trying to create some new capacities, building new factories, will have a backseat in terms of their plans when if there is a prolonged war in front of you. So, and foreign money, foreign direct investment coming into your country also can stop if we have a war. But our situation, I think you may be referring to Indo-Pakistan conflict that is there on hand. I don't think this is going to be any long-term war in place because the your opposition is very weak. It will not take too much to decimate them if we go on a full front war. So from that perspective, even since the news that has come, you are seeing that FIIs are 36,000 crores have come in the last 1 month. So I think as of now, there is really no impact of this narrative. Of course, once and if it starts, there may be some setbacks, but overall, I don't see any major impact right now. Yes, if somebody were to wage a war on us, let's say 10 years later, China decides to invade us, yes, then we will have a very bad time in terms of our stock markets, our currency, and so on and so forth. But right now, we are the stronger party, so we will not get impacted by this. You can see Karachi Stock Exchange, which is going down every day. So I don't think that is an issue. Yes, Vijay, you can invest in MI Evergreen, no issues at all. Uh, Sachit says, what does it mean if delivery percentage is about 40% in daily and weekly, but stock is falling? If delivery percentage is 40%, it means that the total turnover that has happened in the exchange, 40% of that was settled in delivery, and the rest was just intraday turnover. So you can't uh, normally equate that percentage to have an implication on the stock price. But usually you will find that whenever there are trend changes, whenever the trend is changing from down to up or up to down, you will have very high delivery percentage at those points because at the bottom, when the crisis bottom is happening, a lot of stocks will change hands, and there won't be too much of intraday perhaps. And it's the same at the top. So whenever delivery percentage is high, that some trend change is happening, uh, or some big news is about to come in that stock where insiders are taking a disproportionate delivery at that point of time. If stock price is falling, then it is falling. I mean, regardless of whether it is 40, 50, or 60, it won't make too much of a difference. But if there has been a trend of that stock, if you go in the past history of that stock and see that this has only always been like a 20% delivery, now suddenly it is 40%, then that change can be flagging some news or something that is happening, that even at 40% maybe there is more selling that is happening and some news is about to hit the stock. That's why the stock price is going down. Maitreya Bhatnagar says, during downturn, how to handle momentum portfolio? What is the minimum time horizon we should have for momentum small case portfolio? So, like any other investment portfolio, you should be looking at these portfolios with a 5 to 7 year horizon. Reason being that a full cycle can be played over that period of time. And that is just a thumb rule. I mean, there is no assurance that even in that time, any portfolio will give you any. Like for instance, from if you see 2008 to 2013, very few any kind of portfolio, not just momentum, would have given any major returns. Markets peaked out in January 2008, did not take off till 2014. It is because of these last 5 years of gains that our expectation in general has become such that every year we must get 15-20% returns. I think people very easily forget that when markets go up continuously for a few years, they can come down also, and there can be flat years also. So there is, I mean, and China is such a wonderful example of this. Economy is growing rapidly. Last 10 years, stock price no changes. So many other markets also. So don't fall into this mental trap that equity has to go up only. It is going up, it is very nice. We are having growth, so it is likely to go up, but there is no assurance of that happening. So, from that perspective, having long term vision, and in a 5-10 year period, you will always have at least one or two major bull runs. You need to capture one major bull run in your period of uh, your exposure. If you are able to get one major bull run in your exposure, you probably will make decent returns for that entire period. So that's what I would think about this. So Dr. Aryan says, does small case perform better in terms of XRR after all tax implications is being deducted as compared to mutual funds in the long run? I think this is a question that if I answer, it will sound very biased. So why don't you basically look at the performance of small case versus whichever mutual funds you wish to apply taxation, and I say apply taxation in default state that small case entirely is small short term capital gains. If you do that also, which is not true, I mean there is many small cases where we have like maybe 60% or 65% stocks only going to short term. But even if you apply entirely to long term capital gains, you will find that if the small case has delivered, let's say, approximately 2% more than mutual funds, you would have done better. Also note that the small case performance that you see does not include dividends. So this mental calculation most people do, that 12% of mutual fund versus 20% on short term, there's a huge difference. But when you actually sit down to do that calculation, where let's say a mutual fund does, let's say, 15%. So on 15%, you'll pay 12.5% uh, capital gains. So net outcome is 13% roughly. Versus, let's say, if a small case gives you 17% and you put 20% on that, so minus 3.4, so you get 13.6. So mentally, if you do the math, it's not so far off, but it sounds very far off. 12%, 20%, and so on and so forth. So, in my view, there is too much more advantage of small case versus mutual funds. You know exactly what is happening in your account. You are in full control. The money and stocks are with you. Uh, the fund manager's strategy is right there in front of you. The fund manager is accessible. You can ask what you want to ask. I think they are not comparable products. But yes, I mean, returns can be compared. I could say, gold has outperformed equity in the last 25 years. So is gold better than equity? Somebody could take that performance and say one equity class is better than the other, but it's not actually. So everything has a it's a product fit. If your psychology of coming to the market is to buy and forget, perhaps mutual fund is better. If you want to get involved and stay connected with the market, I think small cases are better. So these are few differences that I would think. Uh, Specific stocks about sectors or stocks, I will not be able to take. This one is already answered, so I just wanted to highlight this. This is already answered. Uh, S&P says, how about having five funds, Nifty 500, Momentum 50, Nifty 500, Quality. I haven't tried this, but I mean, if you create a fund of funds, it usually does not result in anything but a very average kind of an outcome, because each fund is like 50 or stocks or something like that. So if you create an average of five funds which have 50 stocks each, you will uh, just be at a very average outcome. Himanshu says, if private equity is taking the cream out of any IPO, what is left now for the retail or to earn, unlike the old days of Infosys and AT? So you are absolutely right. Private equity is not going to leave anything on the table. Rather, they are going to uh, make sure that the IPO is positioned in that way that, you know, the next few years cream is also taken out, and that we are seeing with perhaps 80% or more of the IPOs, that there is nothing on the table even 2 years later post the IPO. So, I mean, these people are sharks. They are the brightest minds out there to suck out all the future valuation of the company. So, we have to become smarter to reject IPOs that are being pushed purely on branding, purely on hype. Uh, but then when we have a bull market, everybody goes blind and everybody wants to flip on day one. So I think that will never change. So the best alternative in my view is to just take a step back. Don't rush for IPOs. Let the IPO come to the market. Let it settle down. Give it 2, 3, 4, 6 months. See, if that company is going to do wonders over the next 10 years, what is the rush to buy it today? Let it settle down. Let people who are locked in into the IPO stocks, let them get liquidated. So stabilizing the initial period, and then building on that. Maybe one or two stocks will not stabilize. They will just rocket up from IPO onwards. In those cases, anyways, you are not going to get allocation. And those will be very, very rare cases. But if you miss one of those rare cases and you also miss 10 cases where your money gets decimated in the next first 1 year, it is better to just avoid that. But if you are playing the IPO flipping game, that I'll put 10 applications of my extended family, and then day one I'm going to flip, that is a very different game from then you don't care about what private equity is doing, then you care about what gray market is saying and all those kind of things. So that's sort of the view on this. Raj says, if I want to enter the market now, which of your strategies would you recommend in general is a good time to enter? So, or there is no good time or bad time to enter. We have shown several studies where from each peak of the market, whether it was 2008 peak, whether it was pre-COVID 2020 peak, whether it was demonetization peak, at any peak, if you start and you bring in your money gradually over a period of time, you have done well. The only conditions being that you stay in the market for long term. You do not move in and move out of strategies. You do not try to time the market. Just let the market do its thing and go for it. And in terms of strategies, you could look at the different sub segments in the market. What makes you comfortable, whether it is large caps, whether it is large cap mixed with gold, whether it is mid and small caps, and decide accordingly. I really cannot recommend, because that's not my mandate of the license. I will skip questions about specific stocks. A lot of repeat questions are there. Manubhav says, how often you rebalance your asset allocation, like half yearly? So I don't do it quarterly or half yearly. I'll try to do it like a year on a yearly basis. But there is no right or wrong here. I mean, there are people who will do it half yearly. There are people who do it quarterly. I try to do it like once in a year, kind of a situation. That also, if I'm feeling a bit lazy, I may do it in 15 months. So there's no one way of doing this. Pankaj says, is there a remote possibility that Nifty may imitate the Japanese index where all-time high was reclaimed after 34 years? Very interesting question, Pankaj. So I've thought about this many times, and I feel that we will do it Japan at some point of time. I feel that given that as we go along this path and India emerging as one of the few growth countries, and if we are able to sustain that growth, there will certainly come a point of time where everybody would want India in a very big way. And when that happens, and if that happens, our markets will potentially do what Japan did in late 70s and 80s, uh, where everybody on the planet wanted to have a piece of the Japanese market. So that kind of euphoria can happen. I don't think it is anywhere near that right now, but I think we are getting a trailer of that it can happen. That see, the amount of money out there is crazy. I mean, we are hardly seeing anything come into India from the perspective of what is the global money pool out there. We don't have the capacity to absorb these pools. I mean, instead of uh, 30,000 crores that has come in the last month, if 300,000 crore has come, would have come in the last month, the market would be 20% higher. So there is not enough depth in our market to absorb this kind of money. And potentially at some point of time, that may happen, that we get a spike of few years of gigantic proportion, which will just be very unlinked to any valuation or anything. It is just that money is coming in and it is chasing the few stocks that we have, and out of the 2,500 stocks, we can hardly have 200 stocks that really have any great quality. So everything is going to chase that, and it may become that the bull market of the decade, Indian bull market of the decade for the world. And if that happens, then you will have a decade of nothingness post that, which China perhaps is seeing right now. Last 15 years, no returns. Japan saw that at one point of time. So irrationality can happen, and if we continue to be the star growth performer, it will happen in India. So there's certainly a possibility, and that possibility actually reconfirms my thought process that regardless of what valuation the market is, you will need an exit plan. So you will need to exit stocks at some point, or perhaps rotate into defensive stocks, because there can be, already we are sitting at 50 to 100 times valuation on many stocks, many key major stocks. So there is hardly any room from the perspective of valuation. But what will you do? I mean, if there is a gush of funds tomorrow, what will you do? You can do nothing about it. I mean, stocks have to go up. What we are seeing in gold, central banks are buying gold at 1,000 tons a year, 1,000 to 1,200 tons a year. They were earlier buying at 400 tons per year. Now suddenly they want to buy 1200 tons per year. So this additional 800 tons demand, how will you satisfy this? The production of the world is 3000 tons and that has been fixed for last 7 years. The production is not able to go up. 3000 tons getting produced, 800 tons India consumes, 900 tons China consumes, rest is all the other countries, and 400 tons was going to central banks. Now suddenly central banks want 1200 tons. So who is going to give that 800 tons additional from where? It is going to come from recycling of old gold. And that recycling will happen once price goes up, so that the recycle or the old gold is motivated to come and sell. So similar thing can happen in markets. Instead of $1 billion a day, you get $5 billion a day inflows. What will happen? Price will go up. You and me who are holding stock will sell. So it is all a liquidity driven game at the end of it. And certainly a prospect like that can happen. May not be 34 years, maybe 5 years, 10 years, but that is also enough to decimate a generational equity sort of mood. If 10 years markets don't go anywhere, nobody will be talking about the markets. I remember 2001 to 3, 3 years markets was totally decimated and people just ran away from the equity like nobody's business. Then again, after 2008 crisis, 2008 to 2013, market did not make a new high. Nobody was in the market. Really, no new money was coming into the market. So it will happen from time to time, but a big one like Japan potentially can happen. Pratipal Singh has a very specific question about some redevelopment of old structures. I I don't think I have any expertise on commenting on that. Sorry. Okay, Sagar says if there is no assurance that equity will go up in the long run, then one should book profit once it looks significant or goal is met and put a proportion of that in safe assets. So assurance nobody can give you in any asset class. What gives you any assurance anywhere? Are you assured that your house is going to go up? Are you assured that gold will go up? Are you assured that uh, any asset class going up? No. It is a bet that you are placing, that you are taking on some risk, hoping to get some returns. There is no assurance of any kind. Assurance is only in the bank, and that has no growth, no real returns. It is just matching inflation post taxation. So assurance cannot be given anywhere for sure. Yes, how you're going to play the market is again dependent upon how we play the market. I mean, we could play it on a valuation game, or we could play it on a momentum game. Uh, we could chase growth stocks. That how we play the market is something very different, and whether equity will go up or not is something different. As long as there's productivity in the economy, and over a long period of time, if that growth is there in real productivity, then prices will chase. Why will prices not chase? But yes, prices may discount the next 10 years of earnings today and then not go up for the next 9 years. That is possible for sure. Karthik says, what is the right percentage of levels to accumulate stocks for long term investments? I don't think I understand this question. What is the right percentage of levels to accumulate stocks for long term investment? So, my approach is not to accumulate stocks that are falling. I believe the question that you're asking is at what percentage of drop should I accumulate stocks? So, our approach is very, very different. We don't touch stocks that are falling. We will pick stocks that are going up and are showing promise of going up. Sagar says, what is your view of investing 10% net worth in real estate for a 6% yield and 5% appreciation in yield and capital raised at 8.5%? Objective is to diversify. It will depend upon whether you are expecting any capital appreciation in this. Uh, at what percentages are you expecting? If your real estate that you're investing in also appreciates by, let's say, 7-8%, then I think it's a good deal. But if that real estate is not going to appreciate more than a few percentage points, like there are, some commercial projects are there, some, then perhaps, this is just about meeting your capital raising cost. But with a smart, perhaps, use of taxation angle, perhaps you can reduce your the interest that you pay on your capital raised, and make some money there. A CA probably will be able to do this calculation better. But I think if the capital appreciates along with 6% yield, and that yield improves, I think it's a good deal. Okay, Nikita and Tushar says, I have. Okay, go. What can I say? Congratulations. Um, okay, there's a question. Sorry. Any thoughts on creating emergency fund now, or wait for bull run to start and then redeem for few amounts? I will not be able to advise you on this. You need a financial advisor, a financial planner for your need for this purpose. Ishan Jain says, is there any chance of world going back to non-fiat currency system, and hypothetically, what will happen to the market if that happens? So I think we are in a phase, Ishan, where we are going to transition from a single reserve currency to a multipolar world over the next perhaps decade. And a non-fiat currency system is probably very difficult to go to, because every government is focused on a deficit financing. So every government, every politician wants to, you know, give doles and give freebies to keep their popular vote together. So this trend is extremely damaging. They have completely forgotten the benefits of having a good budget. So budget dynamics aside, all politicians just want to distribute money. And where will this money come from? It will come from tax paying citizens. So they are actually penalizing tax paying citizens to buy votes for themselves. And this is a global trend. It is not just Kejriwal in Delhi, it is everywhere. BJP also does it, Congress also does it, US Trump also does it, and everybody is doing it. So this is an extremely poor precedence that has started in the world, where more and more funds are needed to satisfy the demands of people who have been made an addict of free money from governments, which is being funded by taxpayers. It's a very, very bad cycle. So to reverse this cycle is probably next to impossible. uh, Maybe some kind of World War III, if it happens and all of us gets decimated and new crop comes up, uh, they can make some new changes to the system. I don't see, and we are very limited in our vision, because for last whatever 80 years we have not seen a world war, so we cannot imagine that situation. But if it were to happen, a lot of systems would change perhaps. So, but Trump, to his credit, if I may give him some, is is trying to make that change to the extent that this entire concept of being reliant on other global partners for their manufacturing and bringing jobs back. The intent was right, maybe the methods were not right. But if each government tries to, have a healthy budget, healthy current account deficit, I think there can be a much better situation. Uh, but I think this multipolar world will balance out a lot of these things, because right now whatever US does, everybody does the same. US prints money, everybody else also prints money. So this competition is good, that there will be a multipolar world where there'll be pressure from each side to not go down that path. Perhaps let's see what happens. Thank you so much for these questions. I'm sorry if I'm not able to take more questions now. This is the end of the session. If there's any burning question regarding any strategy or something like that, you can always drop us a email. We'll take it up. Again, thank you so much for joining, and I'll see you next month. Bye.